Beijing announced today it will suspend some agricultural levies on Canada starting Sunday. China will halt 100% tariffs on Canadian canola meal and pea imports and will halt 25% tariffs on lobster and crab imports until the end of this year.
Canada has just secured a major lobster victory, and the timing couldn't be sharper. China has suspended its anti-discrimination tariff, a 25% punitive surcharge slapped on Canadian seafood at the height of last year's trade dispute. This wasn't a standard import duty. It was a retaliatory levy designed to punish Canada politically and commercially. And now, with one decision, Beijing has removed that penalty entirely and restored Canada to China's basic MFN tariff regime. The impact is immediate. Canadian lobster suddenly re-enters Asia's most profitable seafood market without the price handicap that crippled exports for nearly a year. A shipment that once faced the full weight of a retaliatory tariff now crosses into China at a dramatically lower cost, instantly making Canada the most competitive North American supplier. For coastal communities in Atlantic Canada, this isn't just regulatory housekeeping. It's the beginning of a revenue renaissance at a moment when global protein demand is shifting toward Asia. Underneath it all lies one unmistakable truth. Canada's diplomatic strategy is delivering real commercial gains, while America's tariff-heavy approach continues to hurt its own exporters. Canada gets access, the United States loses ground, and the lobster market is only the beginning. In early March 2026, China formally suspended its 25% retaliatory levy, the anti-discrimination tariff that targeted Canadian lobster and crab since March 2025. This move does not erase China's entire tariff schedule, but it removes the punitive layer that made Canadian seafood uncompetitive. Before today, Canada paid the MFN base tariff plus the 25% surcharge. Now, only the base MFN tariff remains, a gap significant enough to reshape supply chains overnight. This shift aligns perfectly with Prime Minister Mark Carney's broader strategy to stabilize and diversify trade, even in a turbulent geopolitical environment. Beijing's move is a clear recalibration. Just as the United States doubles down on confrontation under Donald Trump, China is choosing to re-engage with Canada as a stable and predictable supplier. Meanwhile, American lobster remains stuck behind the same tariff wall that has crippled its exports since the earliest stages of the U.S.-China trade war. With Washington unwilling to alter course, American exporters are watching the Chinese market, once worth up to $200 million annually, drift permanently out of reach. For Chinese distributors, cold chain operators, and major restaurant groups, the choice is now obvious. Canada is back, competitively priced and low risk. For Canada's fishing towns, it marks the beginning of a fully restored commercial pipeline. China's suspension of its additional 25% tariff on Canadian lobster is not a goodwill gesture. It is a calculated decision rooted in supply reliability, trade diversification, and political signaling. Beijing is choosing a supplier capable of delivering stable volumes without the risk of sudden tariff retaliation or policy reversals. Canada fits that criteria today far better than the United States. With Trump's trade doctrine now reshaping the American economy, China faces too much uncertainty to treat U.S. exporters as dependable partners in sectors tied directly to consumer demand. Canada, by contrast, is proving that a moderate, predictable, and diplomacy-driven approach pays dividends. Beijing's tariff suspension sends a clear message. Reliable partners get market access, and Canada is currently at the top of that list. Before the tariff war disrupted the market, U.S. lobster exports to China generated roughly $150 to $200 million per year. When China imposed its retaliatory 25% tariff, American exports collapsed almost immediately. The tariff suspension for Canada now accelerates this shift. American exporters remain locked out, while Canadian suppliers step into the space they once filled. If U.S. exporters lose between 60 and 70% of their pre-tariff volume, that represents losses in the range of $100 to $140 million annually. Add in the contracts now likely to shift toward Canada due to tariff-free pricing, and the United States could face total losses approaching $150 to $220 million over the next year. Canada, meanwhile, stands to gain substantially. With global lobster exports valued between 450 and 550 Canadian dollars prior to tariff disruptions, China's restored access allows for an immediate boost. A realistic increase of 15 to 30% in China-bound shipments would translate into 90 to 150 Canadian dollars in added sales, equivalent to roughly 65 to 110 million US dollars. When considering diverted demand from the US market, Canada's overall advantage could climb closer to $150 to $200 million in total annual benefit. For a single trade decision, the scale of redistribution is remarkable. What was once shared North American market space now begins shifting decisively toward a single winner, Canada. China's choice reflects the dramatically different trade environments created by Ottawa and Washington. Donald Trump's tariff escalation, meant to strengthen American leverage, has instead undermined U.S. exporters in sectors that depend on predictable pricing and long-term partnerships. Seafood is one of those sectors. Every percentage point of added cost matters, and tariffs instantly destroy competitiveness. Canada's approach has been the opposite. Rather than escalating, the Carney government has pursued a strategy aimed at reopening channels, lowering political temperature, and maintaining commercial stability. The result is a Canada that China sees as reliable and professionally managed. In an era where geopolitical friction shapes prices, supply chains, and consumer demand, reliability becomes a currency of its own, and Canada has built up a great deal of it. In Atlantic Canada, the tariff suspension means real economic change. Fishermen can expect stronger dockside prices. Processing facilities in Nova Scotia and New Brunswick can run at higher capacity. Exporters regain access to a market that consistently pays premium rates for cold water lobster. Shipping companies and cold chain logistics firms benefit from higher volume, creating a ripple effect that strengthens everything from local employment to municipal tax revenue. A projected $100 to $200 million in additional seafood revenue is not an abstract win. It is income that sustains rural towns, supports seasonal workers, and fuels long-term investment in ports, vessels, and processing equipment. For regions that rely heavily on fisheries, the impact is immediate and far-reaching. For the United States, the consequences extend beyond immediate losses. China is not just any seafood market. It is the center of gravity for premium consumption. Once Chinese importers shift to Canadian suppliers and sign multi-year contracts, U.S. exporters don't just lose this year. They lose the infrastructure, the shipping lanes, the cold storage allocation, and the buyer relationships that sustain a market. Unless Washington fundamentally rethinks its trade approach, the U.S. risks being structurally excluded from Asia's fastest-growing seafood ecosystem. China's decision to suspend its 25% anti-discrimination tariff marks one of the sharpest trade pivots of 2026. Canada regains price competitiveness, opens the door to up to $200 million in annual opportunity, and consolidates its role as the premier North American supplier to Asia. The United States, meanwhile, watches its market share erode, its exporters sidelined, and its tariff strategy backfire. Canada did not win by chance. It won because it presented itself as predictable at a time when Washington embraced volatility. And if lobster is the first major sector to tilt in Canada's favor, the real question now is simple: which U.S. industry will lose ground next?
Democrats in the American Joint Economic Committee have released a report raising concerns about declining Canadian visitors due, they say, to President Donald Trump's actions. The report says the negative impacts of President Trump's tariff policies have been particularly stark in states along the U.S.-Canada border.
Here's the headline Washington didn't want to hear today. A new U.S. congressional report confirms that Canadian tourists are disappearing from America, and U.S. businesses are the ones paying the price. The United States is discovering something it hasn't had to confront in a long time. When Canada steps back, America feels it in its wallet.
This isn't a symbolic dispute or a diplomatic misunderstanding. It is a measurable, painful, self-inflicted wound created by President Donald Trump's own tariff and border policies.
The report, released by Democrats on the U.S. Joint Economic Committee, paints a clear picture of a shrinking Canadian presence across America's northern border regions. In Maine, U.S. Customs and Border Protection is reporting nearly a 20% drop in crossings compared to last year. The ferry route connecting Yarmouth, Nova Scotia to Bar Harbor, Maine, usually packed during summer, saw a similar slide in passengers. For restaurants, hotels, retail outlets, and seasonal attractions, this decline has been nothing short of devastating. Local leaders have not minced words. Yarmouth's mayor says that 98% of what's happening is due to Trump's policies, while business owners in Maine and New Hampshire complain of quieter streets, emptier parking lots, and a summer season that simply never arrived. And the numbers confirm the stakes. Canadian tourism contributes more than $20 billion to the U.S. economy each year and supports around 140,000 American jobs. Even though Canadians represent only a portion of total visitors, their economic impact is disproportionately large, especially in small towns where weekend trips from New Brunswick, Quebec, and Ontario used to fill cash registers. Now, that flow has slowed to a crawl. This is where the story turns from tourism statistics into a lesson in geopolitical leverage. Trump's second-term America First doctrine was designed to force manufacturing and consumption back onto U.S. soil. The tariffs placed on Canadian goods, the hostile rhetoric toward allies, and the tougher screening policies at the border were all meant to signal strength. Instead, they triggered something Washington didn't game out: millions of Canadians quietly choosing to stay home, spend elsewhere, and avoid the United States altogether. What makes this moment remarkable is that Canada didn't retaliate in any orchestrated way. Ottawa didn't issue travel warnings or launch a counter-tariff campaign aimed at tourism. The shift was organic, a grassroots reaction from ordinary Canadians who simply had no interest in navigating a political climate where they felt unwelcome. Their collective decision, multiplied across millions of households, has now delivered more economic pressure on U.S. border towns than any formal Canadian government action could have. This trend also fits into the broader strategic landscape of 2025. Under Prime Minister Mark Carney, Canada is actively diversifying its economic partnerships. The country is moving quickly to strengthen ties with Asia, tighten defense and industrial cooperation with South Korea and Japan, and reopen high-level engagement with China after APEC's unexpected diplomatic reset. At the same time, Canada is accelerating investment in critical minerals, energy infrastructure, AI-powered industries, and Arctic security. In other words, Canada is leaning into a decade-long structural shift away from dependence on the U.S. and toward a more distributed network of global partnerships. Against that backdrop, the tourism report becomes a symbol of something larger. The United States is no longer the gravitational center of Canada's economic life, and for U.S. border states, that reality is beginning to burn. Meanwhile, governors in places like Maine and New York are quietly distancing themselves from Trump's tariff strategy. They cannot afford the political cost of empty hotels and half-full restaurants. Last year's visit by Maine's Governor Janet Mills to New Brunswick, an effort to repair relations after Trump's tariff escalation, already signaled growing anxiety. Now, with the data in hand, state leaders have an even stronger case to present to Washington. The trade war isn't hurting Canada, it's hurting Americans. Perhaps the most revealing part of this entire story is how effortlessly Canada has gained leverage. By merely changing consumer behavior, Canadians have inflicted more economic pressure on the U.S. than Trump ever anticipated. This is soft power in its purest form, influence achieved not through confrontation or coercion, but through absence. When your tourists stop coming and your border towns start to empty out, that absence becomes impossible to ignore. This report should serve as a wake-up call in Washington. U.S.-Canada relations are entering a new era, one shaped not by unquestioned alignment but by strategic independence. As Canada continues forging new partnerships in Asia and Europe, its reliance on U.S. markets inevitably shrinks. And as the U.S. leans deeper into protectionism, it unintentionally accelerates Canada's pivot. For the United States, the consequences are already visible. Border economies are now learning the hard way that Canadian visitors are not optional. They are foundational. They keep small businesses open, maintain seasonal employment, and stabilize rural communities that depend on cross-border traffic. Losing this inflow, even temporarily, exposes just how fragile some parts of the U.S. regional economy truly are. Politically, Trump now faces a growing narrative problem. His tariffs have hit U.S. farmers, strained manufacturers, and rattled global markets. Now they're hurting tourism, one of America's most employment-rich sectors. Democratic lawmakers are already seizing on the report to highlight the pattern. Trump's America First approach keeps landing hardest on America itself. And for Canada, this moment provides an unexpected insight into its own influence. The country often downplays its strategic weight, but this report makes one thing clear: Canada matters, far more than Washington sometimes remembers. The congressional report is not just a statistical update. It is a mirror held up to U.S. policy, revealing a simple truth: treating Canada as expendable is a costly mistake. When Canadians decide to pull back, even quietly, the economic ripples stretch across multiple states, thousands of businesses, and tens of thousands of workers. For Canadians watching this shift unfold, there is a growing sense of confidence. Not arrogance, confidence. Canada does not need to shout to be heard. It only needs to act in its own interest, and the world adjusts around it. The real question now is whether Washington will adjust as well, or whether it will continue learning this lesson the hard way. Because if the trend continues into 2026, the balance of economic influence along the world's largest undefended border may look very different, and for once, the advantage may lie entirely on the northern side.
Ottawa calling it unacceptable that Stellantis and General Motors are both scaling back manufacturing in Canada.
Last year, we made 1.3 million vehicles in Canada. The big manufacturers were Toyota at number one, and number two was Honda. They're responsible, for about 3/4 of the production in this country. So we've had a steady diet of promises and pronouncements by the D3, and corresponding with that is a steady decline in their production.
Canada just reached the point of no return. After years of watching the U.S. Big Three downsize, delay, and quietly shift production across the border, one final move confirmed what many in Ottawa had long suspected. The era of relying on American automakers is ending. Stellantis' decision to move Jeep Compass production from Brampton to Illinois did more than disrupt a plant schedule. It exposed a structural truth. Canada cannot secure its industrial future by anchoring itself to an American auto sector trapped in tariff politics and shrinking global competitiveness. The next chapter belongs to Toyota, Honda, and the rapidly advancing EV ecosystems of Asia. What began as a planned relaunch for Canadian workers turned into a quiet exit. Stellantis paused the Brampton line, accepted public support, and then redirected the production to Illinois. The federal government, under Prime Minister Mark Carney, launched a formal dispute resolution process, a rare and deliberate signal that Canada believes commitments were broken. Ontario aligned with Ottawa, reflecting a shared understanding that this moment is bigger than Stellantis. It is the clearest proof yet that the Detroit Three no longer treat Canada as a core part of their long-term strategy. Beyond the immediate dispute, the deeper story came from the data that surfaced in the national conversation. Analysts pointed out that this wasn't an isolated corporate decision, but the result of a 20-year decline. At the turn of the millennium, Detroit's automakers dominated Canadian production. Today, that dominance has evaporated. Toyota and Honda now account for most vehicles built in Canada, while GM, Ford, and Stellantis have steadily lost capacity, relevance, and industrial commitment.
The numbers tell the story with brutal clarity. In 1999, Canada produced nearly 3 million vehicles. Last year, that number fell to 1.3 million, and three-quarters of that output came from Toyota and Honda. GM, once responsible for more than 1 million units here, now produces only a fraction of that. Ford's footprint has shrunk dramatically. Stellantis remains in Windsor, but even that presence feels more fragile than strategic. And this erosion is not merely statistical. It has shaped economic psychology across Canada. Entire communities that once depended on American automakers have endured repeated shocks, from sudden line shutdowns to disappearing investments. Governments have spent years chasing promises from companies whose strategic priorities no longer include Canada. This collective experience has changed the country's tolerance for uncertainty. Instead of waiting for another round of plant closures, Canadians are increasingly demanding an industrial strategy that rewards reliability over nostalgia. This is why the Stellantis pullout hit so hard. It confirmed that the old model is broken and pushed Ottawa into a far more assertive posture than previous governments dared to take. The decline of the U.S. Big Three is no longer a matter of opinion. It is a measurable reality. South of the border, Donald Trump's tariff-heavy America First agenda has pushed auto costs sharply upward. His 25% to 100% tariffs have disrupted supply chains, hindered investment, and created uncertainty that harms both American and Canadian workers. Manufacturing output in the United States has repeatedly fallen this year because automakers struggle with rising costs and unpredictable trade conditions. Far from strengthening the Detroit Three, these policies have highlighted how vulnerable they have become. Meanwhile, Toyota and Honda have quietly become the pillars of stability in Canada. They invest steadily, expand cautiously, and remain insulated from the political turbulence that surrounds the American automakers. They deliver reliability, something the Detroit Three have failed to offer for years. The global context adds an even sharper edge to Canada's strategic rethink. The auto race today is shaped by technological ecosystems, not by national brands. The U.S. ecosystem is slowing under the weight of legacy structures and protectionist reflexes. China, Japan, and South Korea are accelerating because they prioritize innovation cycles measured in months, not years. Their EV networks are integrated, mineral supply chains optimized, and battery breakthroughs constant. This divergence has become too large for Canada to ignore. American manufacturers are pouring resources into defending old market share, while Asian ecosystems are busy defining new standards for batteries, drivetrains, charging, and software. Canada's own critical minerals, from nickel to cobalt to lithium, align naturally with fast-moving EV innovators, not with companies trying to preserve outdated models. This is why Ottawa's diversification push feels less like a pivot and more like an overdue correction. For the first time, Canada can leverage its mineral wealth, clean grid, and advanced workforce to join global leaders rather than trailing behind American stagnation. The opportunity is not theoretical, it is immediate, and countries across Asia and Europe already recognize Canada as a strategic EV partner in a way Detroit no longer does. Carney's strategy reflects this shift. Canada is widening cooperation with Japan and South Korea, strengthening mineral-to-battery corridors with the EU and the UAE, and reopening structured dialogue with China when it serves national interests. The message is simple. Canada will choose partners based on performance, not proximity.
Stellantis may have intended to leave quietly, but instead, it forced Canada to confront a larger truth. The country's auto future no longer lies in nostalgia for Detroit or in hoping American manufacturers will rediscover their former global stature. It lies in forging partnerships with companies and countries that are shaping the next generation of mobility. Toyota and Honda have proven their stability. South Korea and Japan offer advanced battery and EV technology. Europe is seeking dependable North American supply links. China, despite its complexities, leads the world in EV innovation. And as Canada stands at this crossroads, something fundamental is shifting in the national mindset. Canadians are increasingly aware that industrial security cannot depend on another country's political cycles, especially one as volatile as the United States under repeated tariff shocks. Communities that once built their identity around American automakers are now asking harder questions, not about how to bring those companies back, but about why Canada tolerated such dependency for so long. This new clarity is shaping public expectations. Canadians want a future built on partners who invest consistently, respect commitments, and see Canada as essential rather than optional. This moment is not just an economic pivot. It is an assertion of national confidence. The question before Canada is not whether it should pivot. It is how boldly it is willing to embrace the shift. And as the landscape transforms, a larger question emerges for every Canadian watching these changes unfold. If the U.S. auto giants are no longer leading the world, why should Canada keep following them?
Energy, the focus of Ottawa's second round of projects to be fast-tracked by the newly formed Major Projects Office.
We used to build in this country, and we are building our nation.
Prime Minister Mark Carney has made one thing unmistakably clear this week. Canada will no longer apologize for being an energy superpower. In a political climate dominated by Donald Trump's tariffs and Washington's pressure campaigns, Carney has unveiled a sweeping slate of fast-tracked, nation-building energy projects. And the message behind it carries an unmistakable edge. Canada is done waiting for permission. Canada is building again, and this time it's being built on Canadian terms. While the United States is still fighting over partisan identity politics and escalating tariff threats, Canada is quietly and confidently laying the foundations of what could become the country's biggest industrial expansion in decades. And the scale of it isn't symbolic, it's structural.
The Prime Minister greenlit 3 critical mineral mines, a major liquefied gas facility, a hydroelectric plant in the Arctic, a hydroelectric transmission line, and a critical conservation corridor. And that's sort of where they are spread out throughout the country.
In the second round of fast-tracked approvals under Ottawa's newly formed Major Projects Office, Carney's government has moved forward a package of projects that cut straight to the heart of Canada's economic future. The projects span the entire map of the country. They include 3 critical mineral mines, a major liquefied natural gas project on the West Coast, a hydroelectric plant in the Arctic, a new transmission line, and even a national-scale conservation corridor that reshapes environmental planning for the next generation. The LNG centerpiece, the Siloams project, ties northeastern British Columbia's natural gas fields to a new West Coast export terminal, aimed squarely at the booming Asian market. Carney's team says it is designed for one purpose, positioning Canada where the demand is growing, not where political pressure dictates. The critical minerals component is even more ambitious. Ottawa is accelerating nickel, tungsten, and graphite mines that could feed into EV supply chains across the G7, at a moment when China still dominates global processing. 2 weeks ago, Carney's government unveiled a stockpiling and offtake strategy, a commitment to buy and store key minerals to create a guaranteed price floor. This gives miners the financing certainty they need to actually start building. And at the center of it all is the Major Projects Office, a new fast-track agency that consolidates years of fragmented permitting. Instead of waiting 5 to 10 years for approvals, the government says it wants timelines closer to 2. This isn't just a list of projects, it's a declaration. Carney's approach is emerging at a moment when Canada, perhaps more than at any point in recent history, is being pushed to define its own economic identity. Trump's second-term America First agenda has weaponized tariffs, disrupted supply chains, and reshaped North American trade into a competitive battlefield rather than a cooperative system. Trump has said openly that he prefers production inside America and considers Canada's success a threat, not an asset. That context matters. Unlike Trump's bluster, Carney's response isn't emotional, it's structural. He is doing something far more strategic, making Canada indispensable. By moving ahead with LNG exports, Canada positions itself as a long-term energy supplier to Asia at a time when the U.S. is facing slowing LNG approvals due to legal challenges and political uncertainty. Recent U.S. court rulings, highlighted by AP and Bloomberg, have stalled major export terminals, tightening global competition. Carney is filling that gap.
When it comes to critical minerals, the real rival isn't Washington, it's Beijing. Reuters recently highlighted that China still controls the overwhelming majority of processing for nickel, graphite, tungsten, and other industrial minerals. The G7 has been desperate for alternative suppliers. Carney is stepping forward with a direct offer. Canada can be your reliable source, but we must build now. The stockpiling program is a bold solution because it solves the miner's oldest problem. You cannot finance a mine unless the price is predictable. Carney's plan makes the price predictable. This is how a middle power becomes a strategic power.
Major infrastructure in Canada has always moved slowly, painfully slowly. A linear process across 4 or 5 federal departments, plus provincial review, plus environmental assessments, plus First Nations consultation, could stretch into a full decade. The Major Projects Office is being designed to break that cycle. Instead of sequential approvals, everything moves in parallel. Instead of navigating multiple departments, companies go to one office. And instead of watching foreign competitors move faster, Canada finally acts like a country that understands the value of time. There are risks, especially around First Nations consultation. Environmental groups and some Indigenous leaders have warned that fast track must not become skip track. Carney has responded by expanding loan guarantees and equity partnerships so that First Nations communities can become owners, not bystanders. This is the quiet revolution in Canadian nation building. Inclusion through ownership, not just consultation. Trump has spent months escalating tariffs on Canada, from lumber to autos to steel, in an attempt to force more production to the U.S. He has publicly mocked Canada's energy ambitions. He has repeated his false claim that America doesn't need Canadian energy. But the facts tell a different story. As of November 2025, U.S. refineries still import 4 to 4.5 million barrels of Canadian crude per day, according to the U.S. Energy Information Administration. Canada supplies 2/3 of all U.S. crude imports. American refineries are literally designed for Canadian heavy crude. Meanwhile, Washington's LNG approvals are gridlocked, while Canada now has 2 major West Coast export projects moving forward. In other words, energy is the one arena where Trump cannot squeeze Canada, and Carney knows it. This makes the new fast-tracked projects more than domestic economic policy. They are a geopolitical counterweight. They tell Washington that Canada is not a passive extension of the U.S. energy system. Canada is a builder in its own right, with its own markets, its own buyers, and its own leverage.
The brilliance of Carney's approach is that it revives a very old idea. Canada used to build things: pipelines, dams, transmission lines, northern mega projects. Generations of Canadians were raised on the idea that the country could shape its own destiny. This package of projects brings that idea back, not as nostalgia, but as policy. It says, Canada can compete, Canada can supply, Canada can lead, and Canada can do it without waiting for the United States to approve.
Carney's fast-tracked energy plan is not a set of announcements, it's a roadmap. It positions Canada where the world economy is moving: cleaner grids, strategic minerals, Asian LNG demand, and secure supply chains. It reshapes Canada's bargaining power with the United States. It signals independence in a global system where middle powers rarely get to set the pace. And it sends a reminder to Canadians that the world is not waiting, and neither should we. The question now is simple. If Canada really is becoming an energy superpower again, who will feel the impact first? Asia, China, or Donald Trump?